Deutsche Bank released a report of the biggest risks for 2019. Not surprisingly, they seem to have left the failure of Deutsche Bank off the list. Seems rather intentional, doesn't it? Well, today we have encountered an unusual issue. Most assets have been subdued throughout 2019, which was the complete opposite of 2017. Investors are bewildered and are in denial that the nearly decade-long intravenous quantitative easing injection could be running out. What should we do with our 7 shares of Amazon? You came here for the truth, so let me unveil that for you. Today we're going to look at what has happened with Deutsche Bank. I'm going to show you the risks for 2019. We're going to look at how assets performed through 2018, and we can have some expectations for this coming year. I have a lot to get into, charts and articles, so let's begin by taking a look at this. Nowhere to hide. Almost nothing has worked in 2018 for investors. Best performer across US equities, global equities, treasuries, corporates, gold, and real cash. And you could see this little tiny blip on the screen, 0.01. That is 2018. It looks dismal to say the least. And you could see over the years the performance of these different products, and it hasn't been this bad in a very long time. That's what we're seeing right now. There have been so few assets to invest in, and that is worrisome for a lot of these hedge funds, for a lot of these investors that are trying to manage either their own money or the corporation's money or the client's money, and there's not really a place to put it. So many have lost a lot of money, many have gone out of business, many have had to close down shop as a result of 2018. So we'll get further into this today. I'm going to show you the different assets, 2018 return in US dollars, then I'll show you in local currency, and you're seeing at the very bottom of the list Argentina 50%. Turkey is at about 45%, maybe 44%. And you're looking at China there, about 30%. Greece, Ireland, South Africa, all of these countries have really been punished right now through 2018. It just shows us the relationship between these individual countries and the US dollar. Then if I flip over to the 2018 return in local currency, we have a different picture. So at the bottom of the list, now it's Greece at about 25%. China is around there as well. Ireland, Turkey, Austria, Belgium, all of these different countries have really been pushed down this year. A lot of Europe has suffered. You're seeing Italy and Germany and other countries that have not done well as a result of all the turmoil that we've seen geopolitically. The markets have fallen down. All of the emerging markets have suffered beginning in January of 2018, but it just continued to fall throughout the year. While we had the FANG stocks rising from, let's say, February into September, everything fell together from September through to the end of December. And that shows us how interconnected not only sectors are, but of course, globally. This is a globalized world. Whether we like it or not, that's what happens. And you can see the connection of all these markets. Every single cycle, this gets worse and worse. As of 2000, it looked like all markets moved together. And then in 2008, it was even more concentrated. That isn't good because it leaves you with less options. There are less safe havens. There are fewer methods to protect yourself. If you're a person managing money for others, it gives you less options. That looks worse on you, of course. So many people just keep on pushing the mantra of invest for the long term, invest for the long term. And while over a long period of time that might be okay, you still have to be diligent. You can't just say, I'm going to buy this company and it's going to be worth a lot 50 years from now, because it doesn't work like that. Not many companies survive over the extremely long term. You can even see Amazon, Jeff Bezos, talking about how Amazon is going to fail. They're going to go bankrupt. He keeps talking about it over and over again. And while it's probably not going to happen happen in the near future. He's already warning about it because no company lasts forever. They know that. So you have to be smart and you have to understand that in the next cycle, what we could have is a devaluation of assets, and what rises up out of that might not be what was popular or what was attractive in the previous cycle. So things change. It takes a long time to gain back that steam. There are very few companies that were on the top of the list 20 years ago as they are today. Just a handful of companies. And then you look 50 years ago and it's a completely different picture. Things are always on the move. As I mentioned in the introduction, Deutsche Bank provided the 30 risks to markets in 2019. What was interesting about this was that Deutsche Bank failure isn't here. I double checked it. It's not here. They get into a lot of the real issues, but I think it should be 31 risks to the markets because it's a company that is bigger than the biggest of them all. That's how powerful this corporation is because of their connection in with the derivatives that are so dangerous and not transparent. People don't understand them. They have these PhDs who are constantly thinking up new formulas to create derivatives which have little to no underlying assets, and yet they can be valued at extremely high levels. The last time I checked this out, and again, I will provide you an update with this, Deutsche Bank had nearly 50 trillion euro of derivatives. Now that doesn't make any sense. This company, their market cap is nowhere near 50 trillion euro. The GDP of Germany is nowhere near 50 trillion euro. That's basically the value of the entire global economy held in the derivatives books of Deutsche Bank. This is an extreme risk, and you are witnessing this stock declining further and further. I just want to jump ahead and then I'll jump back, but they're just showing us here on the last trading day. Deutsche Bank was up, and although this is the US stock, the point is the same. The company's chairman said its turnaround effort was working and it wouldn't need to rely on government intervention or a merger. Covered this in previous videos, won't get into it again, but it's usually those times in which we need to be most worried. So that's that. Let me flip back to the 30 risks. If you go here, this is perhaps not necessarily in order. I don't know in the way that this was done, but number one is very important. Algo driven, risk parity driven, fire sale in equities and credit continues. This was a big problem, and it was perceived that there would be nothing wrong with allowing computer algorithms to trade in these markets. Already we've seen the dangers of that. We've seen the flash crashes. We've seen the unusual trading patterns. We've seen people like Druckenmiller who had 30% for 30 years, and now in 2018 he said, we can't figure it out. We don't know what to do anymore. And that's not good, because on the way out, as all of these algorithms are trying to sell, that's going to cause many major mishaps, and you're going to see it being unveiled this year for sure. There's going to be a lot of these type of events that take place. Now, whether it's going to lead to a fire sale of assets, I'm not exactly sure, but I can tell you that this will be a problem. Algorithms are a big burden on the investor. They talk about the slowing growth in China and Europe. They're talking here about the trade issues between the US and China. There are a lot of potential disasters that could occur today. What the market needs to see in the short term is that the US and China trade tensions start to ease off. And I mean actually for real, not a bunch of tweets sent out, not a bunch of articles written. There needs to be actual significant changes put into place that ease the tensions and that show that they are in fact importing and exporting to each other increasingly. So we'll see what happens. I don't know, but that's obviously going to be very positive to the stock market. Okay, so we're looking for that. Then we need to see the Federal Reserve come out and suggest, okay, no more hikes, we're done at this point. But what we have is an issue, because if the stock market starts to rise more, then the Federal Reserve has even more incentive to increase interest rates. So it's kind of in this situation where it can't really win in either direction. So we're going to see how that all plays out. I don't think they necessarily listen to the stock market anyway. If you look at all the previous cycles, this hasn't been the case. So why would it be the case now? But anyway, we'll see. time and time again, we see the failure of analysts and their predictions. They try to predict something, and it's usually when all of them are in a consensus, that's the worst idea possible. Apple's road to $2 trillion will be paved with AR and Apple cars. This was written in August of 2016, just before the stock topped. You're looking at it today, it is down significantly. Here's another one. Here's why Amazon may beat Apple to $2 trillion. So hey, is it going to be Amazon at $2 trillion or is it going to be Apple at $2 trillion? And then of course, the stock got hit. We're looking at two massive corporations. I'm not denying that. And I'm not even suggesting that they won't be able to get to $2 trillion. But to just be at the absolute peak and have all of this euphoria, and you could make any exaggerated claim, which then all these people start piling on top while the inside sales are finding their way to the exits. We are going to have an issue here as this happens and as more and more stocks encounter the same problems. This could be exaggerated because of the algorithms, but of course it's hard to tell exactly what's happening behind the scenes. We just know that most trades today are done by computers and there really isn't too much human intervention, which of course again is very dangerous. As I mentioned earlier, you have all of these hedge funds, all of these investment companies, and they have terrible performance throughout 2018 in particular because they don't know what to do anymore. David Einhorn closed out 2018 with his biggest annual loss ever for the 22-year-old Greenlight Capital. The firm's main hedge fund fell 9% in December, extending this year's decline to 34%. Greenlight's posted some of the industry's best returns in its early years, but has stumbled since losing more than 20% in 2015. Here you have some of the biggest investors in the world, and they lost out big time in 2018. A lot of individuals who have the 7 shares of Amazon, they can't figure it out. They're saying, my 7 shares are up since I bought them in 2017, so I don't need to worry. Well, you might want to ask David Einhorn what he thinks about your 7 shares. Looking at this, Greenlight's performance hit its peak in 1997, the year after inception. And look, it's even worse than the performance in 2008. That is not a good sign when you have these big corporations losing lots and lots of money. The people, the clients, the customers are losing out and then they're scared. They don't know what to do with it all. That could be their retirement right there being evaporated. Then they'll have to work longer. They'll have to reduce their living expenses, and all because they tried to get a return on their money and they didn't know what they were doing. They gave it to somebody else, and unfortunately because of the situation, this turned out the way it did. Something a little different, very brief, the education department is wiping $150 million in federal student loans off the books and has begun the process of informing thousands of borrowers that they no longer owe the government money because the schools they attend shut their doors. Now that's an interesting dilemma. We'll see exactly if this gets expanded, but I thought it was interesting that this is in a way wiping the debt off for individuals. Will they continue to expand this? How will people react to it? Will they simply pile on more and more and more? I don't know what they're going to do exactly, but it is interesting to see how the taxpayer has to bail out certain people who take on too much debt. That's not good, and that's why I suggest that we shouldn't be doing all of this. We shouldn't be expanding the debt at the rate that we have been. We are allowing it to occur because, don't worry, the taxpayer will take care of it. We need to reduce the taxation on individuals. We need to get rid of all this business because it goes to wasteful ideas. That's all for this video. If you found it informative, please give me a thumbs up. When you give me a thumbs up, you're supporting the channel, so I do appreciate that very much. If you want the financial education you were not taught in school, these 2 books have everything you need. You can get the foundation, the history, the asset classes, everything about making money, how to do it all. It's in these 2 books, okay? Between the two books, you're going to pay $30 and you're going to get an education that was absolutely left from you on purpose. So check them out at the link in the description. If you're more interested in the audiobook version, you can get that at themoneygps.com.